But yeah, let's find out what the mutual funds are doing with their pile of cash that they've been sitting on. Mihir Vora, CIO, Trust Mutual Fund, right here in the studios to talk about the market construct right now. Mihir, hi, good morning. Good to have you in the studios. You know, we were just talking about as to how picture perfect this scenario is. You've got lower inflation, you've got lower EMIs now thanks to RBI, lower taxes was taken care of in the budget itself, good monsoon, lower interest rates. You think this construct is best suited for the markets?
Absolutely, you said it all.
It is a long list.
It is a long list, and you can say what broadly we can summarize it by saying that the financial conditions are as loose as they can be. And it's the case not only in India, even globally. If you see, central banks have been cutting rates in the last few months at a record pace. So there is a case for a risk-on trade, and that's what we are seeing in the world as well as in India. If you see the Dow, the US markets are also at near highs. We are also touching our highs. So I think it's broadly a risk-on trade fueled by easy money, easy financial conditions. So enjoy the ride.
But still at large, MFs are sitting on cash, or are you guys all in specifically?
We typically don't keep more than 5-7% cash. So we are not sitting on large amounts of cash. But in general, the MF industry, I think, has normal levels of cash. Nothing to write home about in the sense it's not extraordinarily high or extraordinarily low. I think there is enough ammunition on the sidelines, and we can see that in the daily numbers. MFs are buying on a daily basis.
All right, but Mihir, the kind of front loading that RBI has done, well, of course, starting with financials, it will trickle into a lot of sectors, be it from real estate, autos, consumer discretionary. What's your preference list like? Because in terms of the stock picking, yes, of course, we know that financials is one of the sectors that you're betting on. But in terms of the preference, how do you line it up?
So that's, the fact that there will be I would say a knee-jerk reaction to the rate cut is a given. So we should see that impact in the next few days also. We saw some impact on Friday, but it should continue for a few days. But if you look at the aggregate picture, the demand conditions on the urban side are still not picking up, right? If you see the car, for example, two-wheelers are doing, have started picking up a bit, but cars have not picked up. And plus in auto, you also have the threat of China, holding back some of the crucial raw materials for magnets, etc. Real estate, again, sales have been robust on the high-end side. On the low-end side, I think there is still traction to come. So I think what the government is doing is that they realize that they tightened too much. RBI and the government tightened too much last year. RBI was anyway keeping things tight, and the government also slacked off on spending because of the election, right? If you look at the March numbers, government spending really shot up quite a lot. So I think the government and the RBI are both trying to play catch-up to make sure that the impact of last year does not stay too long. So we did see a cyclical slowdown, and they're now trying to make sure that we don't overdo the mistake of last year. So maybe they are probably even overcompensating, which is not a bad thing.
Right, Mihir, I was reading your most recent report wherein you've mentioned 7 drivers of the next 2 decades in India. Tell us a little bit more about that and the sectors that stand to gain the most from these drivers.
Sure. So, these are more of the macro trends, as you can say, the mega trends, if you say things like, demographics, digitization, democracy, which are part of our, structural story. Then you have things like digitization, which is technological disruption, in which India has actually leapfrogged into a lot of technology. And then you have, things like physical infrastructure creation, which is going to be the story for the next few years, because if you have to compete with China, we have to create a lot of infrastructure. So the 7 Ds basically talk about these 7 mega trends. The themes that arise from these are basically financialization of savings, right? Physical asset creation. So in financialization of savings, for example, you have all the lenders, of course, will do well because you have to grow at a GDP plus. But then the capital market players, the wealth managers, the broking, the asset management, those will continue to do better. Everything which will tap into the higher savings pool, because as income levels rise, the saving pools rises at a rate which is much faster than GDP growth, right? So the capital market link, the savings link players will grow faster than the lenders. Physical asset creation is all the things that we talk about in terms of job creation, China Plus One, Make in India, Atmanirbharta, defense, T&D, all the sectors where we have to invest a lot to sustain this 6-7% growth. So that's the physical asset creation theme. So financialization of savings, physical asset creation, and the third theme that we like is digitization, where basically new age companies, new business models, disruptive business models, those are the kind of things that we like. And I think these are plays for the next 5 to 10 years, so we'll just stick to them.
But Mihir, when you look at 5 to 10 years, yes, everything looks quite okay. But everything in the market is a function of the price at what you've bought or paid.
And the point is that these valuations and these kind of market levels, you have to take a longer term call, right?
Yeah, you have no option. But that's what I'm saying. Listening to you, if someone says, okay, I want to put my money now into capital market themes, where is the opportunity? Because you've already seen such a big run up.
The thing is that here is where our kind of inherent philosophy of terminal value investing comes into play. Because the way we look at it is that markets end up optically paying a higher premium for stocks which have a long runway of growth, right? So if the runway of growth, for example, the capital market players is not 3-4 years, but 10, 15, 20 years, then these stocks will continue to look optically expensive on the next year's PE or the 2-year, 3-year forward PE. The point is that the market is assuming or giving credit to the fact that these sectors probably will grow at say 10, 15% or 15 to 20%, not for 6-7 years, but maybe even for 15 years. Now, no analyst builds in a growth rate of more than 7-8% beyond 10 years. That's where the philosophy goes wrong, because we've seen year after year, in the last 30 years, there have been so many stocks and sectors which grew for 15%, 20% even for 20 years. That's where the valuations start looking expensive. And these stocks, even 20 years back, looked expensive. And 5 years ago also they looked expensive, So that's the kind of...
NSE is not even listed and it's quoting all that
exactly.
valuation.
So in high growth stocks and sectors, especially stocks and sectors where the runway of growth is very long, you will end up paying a optically higher premium in the shorter term.
But Mihir, back in the month of March and April, where we were seeing that the markets, there was a sell-off and a broad-based sell-off rather, the consensus call was to stick with the large caps. But now you're highlighting that it's a risk on in the markets. Do you believe that now is the time, and now given the fundamentals, how they're shaping up, maybe can one start allocating more towards this mix?
Definitely. I think, every dip is a time to buy, frankly, because as they say, it's about patience and conviction. Your patience will be tested, but your conviction will be rewarded, right? So it's in times like these that you really, go and stick it out, and probably even if you have the, courage and the capacity, add more, so to say. Because ultimately you will have to take a longer term call on the India story. Whether India will do better than the rest of the world over the next 10, 15, 20 years. If the call is yes, then every dip is a time to buy.
But with the launch of your mutual fund, you have highlighted, or you have rather come up with the stock picking in a gorilla style. So anything new addition to that list of late?
So because of our inherent, terminal value investing style, which is what the gorilla picking, identifying potential gorillas is concerned, we end up having a much higher profit growth portfolio. So our earnings growth for the portfolio on an average is much higher than the index, or even the peer group for that matter. But on the converse side, as we discussed, these are themes and segments which have a long trajectory of growth in our view, which means that optically our valuations in the shorter term, as far as PE ratio or something like that is concerned, will also look higher. So we have a higher growth, earnings growth, but optically a little bit of higher PE also in the portfolio. That's how the portfolio characteristic is.
Mihir, when we interacted with you last quarter, you were underweight IT, but positive on financials, industrials and healthcare.
Yes.
Post the quarter 4 numbers, has the stance changed anywhere? Have you seen any re-rating in your portfolio?
I think healthcare is something that we have reduced a bit.
Okay.
A little bit of the Trump effect of, a lot of uncertainty there. And plus we needed to allocate money elsewhere. Otherwise, we continue to be neutral to underweight on IT and positive on financials, especially the non-lenders. But after the RBI's action, probably even the lenders are looking as attractive now.
Yeah, they are. So let's talk about the unknown, which is we don't know how this entire tariff situation under Trump is actually going to play out. Would you say look at just inclusive sectors, the domestic theme, rather than globally exposed sectors? I mean, is that a rational way to look at how to invest going forward from here?
See, first of all, Trump is a taco trade, right? It's all getting undone. So the taco trade is something that we are anyway betting on. But the point is that even without Trump and the tariff actions, we were always of the view that the domestic economy will grow faster, domestic segments will grow faster than globally linked segments. So that theme I would agree, we will continue. So financials is mostly a domestic theme, and that's the largest piece of the action. But ex-financials also, things like industrial, automotive, components, construction, then utilities, but not the the regulated utilities, but private sector utilities. Those kind of names I think will continue to grow faster.
But specifically on the auto side, Mihir, what's your take on the EV story playing in? The reason I ask this is because a lot of these companies, how much do you believe is already in the price with respect to the expected EV growth story to pan out in the India? Because the EV sales hasn't been doing that well in the Indian markets, and one of the biggest players, that is China, the companies are now slashing the prices drastically, and which is a bit of a concern.
Sure. So in EV, I think it's going to be more of a company by company story.
Okay.
And earlier it was a case of global companies versus Indian companies. But I think Indian companies have managed to stand their ground. The incumbents. So it was incumbents versus disruptors. But the incumbents have kind of stood their ground. Ultimately, I think it's not a very complicated product. It will ultimately boil down to product development, branding, marketing and distribution, where the incumbents are anyway very strong in the distribution, sales and service. Ultimately that will matter. We have seen, for example, in India two-wheelers, beyond a certain scale, we were able to be the Chinese in the global markets. So, right? So, and we have scale. So India, the biggest advantage of India is that the domestic market has scale. The two-wheelers, we have proved that. The car market is still very small compared to, say, China or the US, but I think we are getting there.
Okay, and also want to understand, where does defense rank in the list of all the sectors that you're liking right now? Because it's been a case of too much too soon for the defense stocks in case of the run-up that we've seen. But if you take a look at individual stock action, the order wins and MOUs and positive news flows, they're not stopping or they're not slowing down. So how are you playing and approaching the defense space?
See, defense has been one of our favorite sectors, even before the border issue. And that's because of the fact that it's a sector which is coming up for the first time, right? So it's very rarely that you see a sector emerging, right? And this is one sector which was close to the private sector, closed for scrutiny, closed for, this thing. But now the government in the last 10 years has made it very serious that they want to indigenize. And once you indigenize, you have the ecosystem up and ready. You're able to export also. We've seen it in sector after sector, In pharma, we are nothing. But now we are the biggest exporters. IT, we were nothing, but now we are the biggest exporters. Auto components, the same. So whenever the private sector is just allowed to be and do its thing, I think we have done well, right? Yeah. And for the first time, we have allowed private sector to come into the defense sector. And I think that's, it's a blue sky scenario.
So where do you think this kind of a new sector creation could actually happen next, Mihir? I know it's not going to happen today, tomorrow. It may take some time. I mean, defense, we didn't talk about it till I think last 3 or 4 years?
Absolutely.
Where do you think that next sizable opportunity is going to be?
See, ultimately I think the biggest investment will have to be made in manufacturing for India. And it will come, whether we like it or not. If we do well, it will come at a faster pace. If we don't do so well, it will come at its own pace. But the fact is, the world is running out of labor, right? And India has proven that, beyond 5-7 years, after 5-7 years, we are able to adopt any new technology, right? People were saying we don't have drones, people are saying we don't have this and that, but in the recent border, we had all the technology to not only have drones, but anti-drone also, stuff like that. So India is able to adapt to technology. Right now, for example, magnets. So people are saying China, is not supplying raw materials for magnets, etc. But India has some of the largest reserves, which we have been lazy enough to not exploit. It's the process, exactly. But see, it's not something that you can't throw money at the problem. If you throw money at the problem, you'll be able to solve it. And we have the people and the intelligence too. So I think manufacturing, automation, even robotics is something which is going to be a big theme for India.
But any sub-segment within manufacturing, Mihir? Sorry for interrupting, you can please.
So to start with, frankly, textiles is the basic bit, the lowest end of the job which we haven't even exploited. And all the way to robotics and also, if I look at the unlisted space, there are hundreds of startups doing stuff in AI, in automation, in robotics and all. And in the next 5 to 10 years, I think we'll have a substantial amount of listed companies in that space.
So are you launching any thematic fund?
So far we don't have any unlisted company portfolio. That'll probably be in the AI space, which will start later.
Okay, looking forward to that. Good speaking with you, Mihir. Thank you so much for your time today.